Well, welcome everybody. Thanks for joining us. This is our next session of our virtual investor series. For those of you who didn't catch the last session, my name is Andy Langsher. I'm the founder of Venture Real Estate Group. We're a investment, development, and brokerage firm based here in the Great Northwest. And we're very thankful to have Michael Gaberman joining us for the second session. Michael.
Thank you, Andy.
Yeah, thanks for being a part. Michael's a private banker with Washington Trust Bank, does a lot of construction financing, as well as land assemblage deals, which is huge, as well as bring in permanent financing if needed. Did I miss anything?
No.
Yeah, great. So we're going to jump right in. So this is our second session. We'll be covering a larger project. We co-developed a 100+ unit project, so we'll be just going over some questions, and we're gonna jump right in.
Sure.
So, for lending for a project like this, a 100+ unit project, what differences in lending occur in a large institutional sized deal rather than a small one, would you say?
Well, the takeout financing and really the stabilized revenues have to be projected with some certainty so that you know going into the beginning of the project, you know what your takeout is and what, more importantly, the parameters of the takeout are. And we're sitting here in October 2020 and they're radically different than October 2019 and even March of 2019. A lot of the permanent financing options that were available don't exist anymore, and a lot of the pools that were set up to put multifamily properties and really investor type properties have changed, or if not completely stopped right now. So almost on a 30-day cycle, we have to look at, all right, where is this thing going to go for permanent financing? And if it doesn't go the way we think, are we comfortable holding this for a 2, 3, 4 year period based on that? And so as a commercial bank, we've got to not only do the land assemblage, but the construction financing and offer the client a mini perm, because the takeout market is very fickle. And so we want to make sure that we can live with the deal if it takes a while to get the project completed beyond the original scope, and maybe the rents don't perform or the rents outperform what those models are. I can say with absolute certainty that any models we create on a large project like this that could take a 2-year cycle to get from the dirt to being leased are completely inaccurate. And so I've seen them come in 20-30% below and 20-30% above, depending on where we are in the cycle.
Yeah, that makes a big difference. What just made me think of measures that you or at the bank are putting in place with some of the projects that you're working on.
Well, the most common measure is what the secondary market's going to accept, which is really the debt service coverage of the property at a stabilized basis. And so we want to make sure that we have all the inputs, i.e. the revenue sources and all the expenses, the costs to go out. So we really have a very distilled number of what that net operating income is going to be. And then we run it through a couple different scenarios, essentially shocking it and moving the interest rate up, 0.5% or a full percent, to say how much can we live with assuming this scenario. Rates over the last 6-7 months have come down. However, the margins that financial institutions are willing to take haven't come down as much as the rates have come down. And so a lot of financial institutions have set floors as to where they're willing to go. So there's a lot of information out there right now, and until the economy comes out of COVID, which we're in the middle of, and we have a better understanding of when people are going to be able to occupy these things, then we can get maybe a 3-month or 6-month time horizon on these things and get a little bit more comfortable.
Yeah.
But the debt coverage ratio is really the jumping off point for this.
Yeah, big deal, big deal. Knowing, okay, how much is my debt going to really be covered? And what if something goes wrong?
Yeah.
Or maybe not goes when, but if, but when.
And as a rule of thumb, depending on the type of occupancy levels and where they're going to price it to market, anywhere from 115% to 130% debt to income ratio are where most permanent lenders want to see a project come in at. And I've seen numbers spike as high as 160 in the middle of the summer, because They're just basically quoting a miss. They don't have any appetite to do any lending, and so they've changed their internal parameters. And so we have to adjust how we do projects if that was our client's specific takeout strategy, and redirect them to something else, or be prepared to do something internally at the conclusion of the project.
No, it's good. Yeah, it's true. It's really good. I'll start the second question with a statement, and we'll talk about what issues can come up in a bigger project. We had an issue on our project. We were actually about to fund the construction of our 100+ unit project, and our contractor had an internal issue where one of the main partners ended up getting fired. And we actually had to find a different contractor, which means that our project got delayed. We found a different contractor, built our project. It's about 98% occupied for several years now, so it's going great. But that's a prime example of something going wrong, where we obviously solved the problem. But what issues have you seen come up and solve them?
Once the project is underway, clearly the general contractor takes the reins, and with the owner's rep or the project manager, they're pushing the project through a fairly complicated execution phase. The dialogue that the owner has with that general contractor is paramount. We're a 100+ year old financial institution here in Washington, so many of these general contractors have relationships with us, especially the larger ones. So we know what the depth of their capacity is, and we're always very positive if one of our clients is selecting one of those general contractors, because we've seen them perform in good times and in bad, and that carries weight with us when we're making decisions. But I think it's fair to say that every construction project is going to go sideways at some point in time. It's how do we get this thing back on track, and does everybody recognize whose fault it was and what the resolution is to get it back on track? Yeah,
no, that's good. So you're knowing and having a relationship with those contractors, and from your perspective, is big.
It's paramount.
Yeah, no, it's good. Third question: how has the financing of larger deals changed since COVID?
I think I alluded to it earlier.
Yeah.
The debt service coverage ratios that some of the institutional lenders have increased, and it's really not a function of the property, but more their appetite. Most institutional lenders that offer the most aggressive financing terms have a wide spectrum of real estate projects, and they typically provide that financing and they pool that money into bonds and sell them into Wall Street. Well, that wide variety of investments, their hotel tranche, their shopping center tranche, those bonds are now trading at 30 to 40 cents on the dollar because of the lack of the ability of the tenants to pay for anything. And so they have to maintain the liquidity to run their company and to still grow. So they're quoting what we call misses in the industry, and quoting very high debt to service coverage ratios, because they don't want to do any new deals in that space. They want to do deals that are going to perform. You have an additional issue in that you've got government intervention. Here in Washington, you have both state and city issues that prohibit people from evicting tenants for non-payment. This is the first time this has ever happened. And so how do you deal with those type of things? Those are non-financial issues, but they create financial impacts to the project. There's a lot of things that have come up that have never come up before in the last 6 months.
Yeah, no, it's good. So during due diligence, those items are huge to make sure that those are taken into account.
Absolutely.
And not missed.
Well, that's one of the reasons during the land assemblage and the construction, that we do recourse loans, because that's where the greatest risk is and a lot of the variability can come in. And so when we do a recourse loan, we want to make sure that the individual that's backing the project or the sponsor has another set of funds to go to, and it's not their last dollar, because something comes up, and if there's a change order, if there's a big miss and it costs $500,000 on one of these large projects, you want to make sure that you maintain that timeline, because if you have to pause to figure out how you're going to get that $500,000, it's going to cost you double that amount just to try and figure out where you're going to get it from. So it's nice to have that in reserve and identified up front if it's needed.
Yeah, so borrowers who have the reserves that are needed to...
Especially on these larger projects.
Oh yeah, absolutely. No, it's good. Next question. What's an example of a syndication or institutional size deal you would avoid in this current market?
Well, anything that has a large reliance on retail and even office. In Seattle, you're going to see a large amount of office space become available on the lease renewals, and everyone is guessing where it's going to be. We're paying $1 million a year for our office space just in downtown Seattle, and we've had 10 employees there for the last 9 months, and we have well over 100. So do we really need that office space? And so
you're asking that question yourself.
Everybody's asking that question.
Yeah.
And what do we want to do? How do we want our business to look? The nice thing about what has come out of COVID is all the digital banking services have come in 6 months where they would have been in 5 years, because everyone has learned and been forced to work remotely, and they're realizing they can be as efficient as they can without a physical office. You don't want to lose the nature of having that physical office, but how much real estate do you have to pay for? And so people are going to start to think in more traditional businesses like the technology businesses have for a decade or two, where, hey, you can work remote 90% of the time and just fly in for meetings. So there is a wholesale shift going on.
Yeah, it's true.
I'm not in a suit and I'm in a beard. So, and it's the middle of the week. You figure it out.
Yeah, it's more relaxed.
Yeah,
more relaxed. All right, what do you see happening in the economy and capital markets going into 2021?
Wow, it really depends on how
and beyond.
Yeah, how the election shapes out. Obviously, there's going to be two specific paths. If the Republicans maintain control, you're going to see more benefit for the wealthier classes in the form of different levels of incentives and tax breaks for different things. And the market, this is a general comment, but the market is disconnected with what the economy is. So you can't look at that too closely. And then the reverse is true if the Democrats there's a tremendous amount of spending that's going to happen, but at whose cost? There's a lot of things that are being proposed in Congress right now. And, the one thing that I can say for certain is here in the U.S., we've had the highest interest rates for a long time. We've just added $3 trillion of debt at a fairly high debt burden for our economy to service. And for the first time in my professional career, you're starting to see negative interest rates, which has happened in Europe and has happened in Asia for many years now. And it's going to be interesting to see what the returns are going to be. But overall, the expectation is you're going to, if you can get 3 or 4% after-tax returns in a real estate investment, that may be a good return going forward, because your alternatives are going to be negative if you're just going to park it in cash.
No, it's true. No, it's good. It's good points. Good points. How are your current clients' projects going, vacancy-wise, on the multifamily side?
Yeah, there's
the larger projects.
Well, we're having to be fairly flexible, because I think we extended probably bank-wide, we extended the principal and interest repayments on about 400 loans to interest only for a minimum of 90 days. So a lot of clients had permanent financing in place on investment projects, and there was a lot of concern, depending on who the tenant mix is, whether it's an apartment project or a retail or an office, how are these people going to pay these rents? And so we got very conservative and said, you're a great client, let's go put you on 90 days of deferred payments, and we'll catch it up at the end of the maturity of this thing. So it gave the clients a little bit of working capital to figure out, and less pressure to go negotiate having to make a debt service every month.
Yeah.
And that was the right thing to do, and we had the ability to be able to do that. But most of those clients have now started the principal and interest payments, maybe not at the full amounts, but now that those tenants have stabilized, they kind of know where their cash flow is going to be as we've gotten through the summer unknowns of the whole COVID scare.
Yeah, absolutely. So most of your projects are going well.
Yeah, I would say so. I mean, I don't know of a single one that's completely stopped. We've paused on a couple projects that had 100% retail components, because that's a big unknown. And some of those projects had national credit tenants, but just this week you saw, the Gap stores going to shut down 200 plus of their inline stores in the malls across the country and just handle their freestanding stores. So you're seeing a lot of retail tenants change their business strategy going forward depending on what's happening in the economy. So we're just, anything that's got a retail or an office component,
It's more risky.
yeah,
A lot more risky.
It's beyond risky. It's hard to ascertain what the risk is.
Yeah, no, it's true. It's true. Yeah, it's important to look at that, especially for new projects, where it makes the most sense to invest. That's for sure.
People still need a place to live. So
Yes. Yeah.
at the end of the day, that's one of the safest investments to make in real estate.
Absolutely. Single family. Yeah.
Or
No, it's very true.
or a multifamily if
Or
they
multifamily.
can't afford a house.
Yeah, that is exactly right. Well, I think that about does it for our last session. Michael, thank you. If
You're
there's
welcome,
anything else
Andy.
you wanted to add.
So, I mean, I just stay tuned, everybody. Obviously, there's going to be specific to the larger projects. You're seeing some projects that are under construction right now and in lease up. And sitting here in October, you're seeing some for sale projects that were condo projects convert to apartment projects. There's been a handful in Seattle this last week or so. And so people are trying to be responsive to what's happening in the market, and it's going to be a lot easier to rent out an apartment building than it is to sell 300 condos in an apartment building with what's known in front of us right now. So
Absolutely. Yeah,
just have your plan A, and then your B, and then your C, especially for 2021.
exactly. Well, those potential condo buyers are absolutely going to prefer to be in a single family home. That's for sure.
Yes.
But apartments are still leasing. Just obviously those apartments taking the necessary measurements that they need to take. So, well, Michael, thanks.
You're welcome, Andy.
Thank you, everyone. Thanks for joining us. Hope you got a lot out of it, and enjoy the rest of your day.